The trillion-dollar warning sign BlackRock just moved over $2 trillion out of American investments, and almost nobody is talking about it. The world's largest asset manager has been quietly restructuring its portfolios, pulling capital away from US Treasury exposure and redirecting it toward European infrastructure, Asian real estate, and emerging market opportunities. A company that controls more than $10 trillion in total assets doesn't make shifts like this on a whim. Every major reallocation goes through layers of analysis and risk assessment that most people will never have access to. This matters because BlackRock isn't alone in making these moves. JP Morgan has restructured institutional allocations recently. Goldman Sachs reduced its U.S. equity recommendations. Morgan Stanley increased guidance toward international positions. The pattern is consistent across major financial institutions, and it raises an obvious question about what these firms are seeing that the general public isn't. The answer probably has something to do with $38 trillion. That's how much the United States government currently owes, and the number grows by roughly $6 billion every single day. In fiscal year 2025 alone, interest payments on this debt hit $970 billion. That's nearly $1 trillion spent just on interest before a single dollar goes toward defense, or healthcare, or infrastructure. The Congressional Budget Office projects these interest costs will climb to almost $2 trillion annually within the next decade. When debt reaches these levels, it starts to change how investors think about risk. Treasury bonds have always been considered one of the safest investments on earth because the US government has never defaulted. But safety is relative, and returns matter too. If inflation stays elevated and the dollar weakens against other currencies, holding American debt becomes less attractive even if it technically remains safe. The big institutional players seem to be doing the math and deciding that better opportunities exist elsewhere. Foreign governments have noticed the same thing. China reduced its treasury holdings from over $1 trillion to around $760 billion. Japan, still the largest foreign holder, has been selling off portions of its long-term positions. Central banks around the world have been buying gold at record rates, diversifying away from dollar-denominated reserves. And this does not mean collapse is imminent. But it does suggest that confidence in American financial dominance isn't what it used to be. Something is shifting beneath the surface, and the biggest money managers on earth are already repositioning for whatever comes next. A pattern that keeps repeating every dominant economy in modern history has followed a surprisingly similar path. And the pattern becomes obvious once someone points it out. There are basically 4 stages that show up whenever a major financial power begins its decline. The first stage is the rise to dominance, and it typically lasts somewhere between 50 and 80 years. A nation becomes the center of global finance. Its currency becomes the one everyone wants to hold. And capital pours in from all over the world. Everything feels permanent because nothing on the surface suggests it could ever end. The second stage is when spending gets out of control, and this phase usually runs for about 20 to 40 years. Military budgets expand across multiple regions. Domestic programs grow beyond what revenues can support, and debt becomes the easy answer for every problem. Asset prices keep climbing so nobody worries about the borrowing, and central banks keep printing to keep the whole system running smoothly. The third stage is when the smart money starts leaving, and this window is much shorter at around 18 to 36 months. Big institutions quietly reduce their exposure and move capital into foreign markets and hard assets. Wealthy families diversify internationally through private banks and offshore structures. None of this makes headlines because the people involved have no interest in causing a panic before they finish repositioning themselves. The fourth stage is the collapse, and it happens faster than anyone expects. The currency loses its reserve status. Inflation spikes as foreign-held money floods back home. Interest rates surge and asset prices crash across every category simultaneously. What takes decades to build comes apart in months. And the people who get hurt worst are the ones who aren't paying attention during stage 3. When Spain ruled the world 500 years ago, Spain was the most powerful nation on the planet by a wide margin. Treasure ships crossed the Atlantic carrying silver and gold from Mexican and Peruvian mines, flooding the Spanish economy with wealth that no European kingdom had possessed before. The Spanish real became the currency that everyone needed for international trade, and Madrid emerged as the financial capital of the known world. This was stage 1, playing out exactly as the pattern predicts, with Spain entering a golden era of dominance that would last for nearly a century. Stage 2 kicked in once the spending spiraled beyond control. King Philip II controlled territories across 3 continents, and his empire stretched from the Philippines to Peru. Military campaigns spread across France, England, the Ottoman territories, and the rebellious Netherlands, all at the same time. Royal palaces grew more elaborate each decade, while armies and navies demanded constant funding on multiple fronts. By the middle of the 1500s, government spending had reached 3 times the amount collected in taxes every single year. Italian banking families and German merchant houses covered the gap through loans carrying interest rates as high as 40%. Nobody panicked because the treasure ships kept arriving and asset values kept climbing. Stage 3 began quietly around 1555, when the creditors started changing their behavior. The Fugger family had been Spain's largest lender for decades, but they began demanding repayment in physical gold rather than paper promises. Major banking operations relocated from Madrid to Genoa without any public announcements about their reasons. Wealthy merchants opened offices in Amsterdam and redirected trade routes away from Spanish ports. These people understood accounting, and the numbers told them Spain was functionally bankrupt despite all the colonial wealth flowing in. The exodus of smart money took about 2 decades, though most of it concentrated in the final years before everything fell apart. Stage 4 arrived with the first official default in 1557, when Spain simply stopped paying what it owed. Credit markets froze and Spanish bonds became worthless practically overnight. Government officials seized private gold shipments to cover military payrolls, destroying whatever confidence remained among investors. Spain defaulted 3 more times over the following 4 decades. In 1560, 1575, 1596, the currency lost its value. Inflation crushed ordinary families, and the empire that had dominated the world began collapsing from within. The financial center of Europe shifted north to Amsterdam, where the Dutch Republic was already building the next great economic power. The rise and fall of Dutch money after Spain's decline, the financial center of the world moved north to a small nation that would become extraordinarily wealthy in a remarkably short period of time. The Dutch Republic in the 1600s was unlike anything Europe had seen before. A merchant nation built entirely around trade and banking rather than royal conquest. Amsterdam became the richest city on earth, and the guilder became the currency that every serious trader needed to conduct international business. The Dutch East India Company dominated global commerce in ways that modern corporations can barely comprehend. Adjusted for inflation, this single trading company would be worth over $8 trillion today, making it larger than Apple, Microsoft, and Amazon combined by a significant margin. The Amsterdam Stock Exchange became the first formal stock market in history, and Dutch banks provided financing for ventures spanning from Indonesia to Brazil. Capital flowed into Amsterdam from every corner of the known world, because that's where the money was safest and the returns were greatest. A small republic had become the undisputed financial capital of the planet, which is exactly what Stage 1 looks like when it reaches its peak. Then the military spending started draining the national wealth at an alarming rate. The Republic fought 3 separate naval conflicts against England between 1652 and 1674, each one consuming enormous resources. Prolonged engagements against France stretched the budget even further during the same period. Government debt exploded from 4 million guilders in 1650 to 80 million by 1690, a 20-fold increase in just 4 decades. Tulip mania became the most famous symbol of how detached Dutch markets had become from reality. With single bulbs trading for more than the price of Amsterdam houses, the Bank of Amsterdam, supposedly the most trustworthy institution in Europe, had been secretly lending out depositor funds to cover government expenses since 1672. Asset prices were completely disconnected from fundamentals, while debt piled up faster than anyone wanted to admit. And that's textbook Stage 2 playing out in real time. Around 1690, the people who actually controlled large amounts of capital started behaving differently. Major banking families began quietly transferring operations to London without any public explanation. Sephardic merchants who had helped build Amsterdam's financial dominance started relocating across the English Channel. Portuguese traders and German financiers followed over the next several years, each one reducing their exposure to Dutch assets. The insiders who actually understood what was on the Bank of Amsterdam's balance sheet were getting out, while ordinary depositors had no idea anything was wrong. Money was leaving the country through back channels, which meant Stage 3 had officially begun. French revolutionary armies invaded in 1795, and the entire system collapsed almost overnight. The Bank of Amsterdam's fraud was finally exposed, and depositors discovered their savings had vanished decades earlier. The guilder became worthless, riots erupted in streets that had been paved with merchant wealth, and the Dutch Golden Age ended permanently. Everything that took generations to build fell apart within months, and financial power shifted to London, where the British Empire was already rising. Stage 4 had arrived exactly as the pattern predicted it would. When the sun set on sterling, Britain had been building financial power for decades before the Dutch system collapsed. And by the mid-1700s, London had fully taken over as the center of global finance. At its peak, the British Empire controlled nearly a quarter of the Earth's landmass and governed about 23% of the global population. The pound sterling served as the world's reserve currency for over 200 years, longer than any currency before or since. More than 60% of all global trade was invoiced in pounds during this era. British capital built railroads across America, developed mines in Africa, and funded plantations throughout Asia. The gold standard itself was structured around sterling, and any nation wanting credibility in global markets needed access to British banking and British currency. Then came to world wars that drained the treasury down to nothing. The First World War alone cost the equivalent of over $600 billion in today's money. And national debt exploded from 30% of GDP to 130%. Britain tried desperately to stay on the gold standard, but failed in 1931 when reserves ran dry. Then failed again in 1933 after a brief attempt to return. The Second World War piled on even more debt, and Britain emerged technically victorious but financially shattered, completely dependent on American loans just to keep basic government functions running. Around 1949, major corporations like Unilever, Shell, British Petroleum started redirecting investment toward America rather than expanding at home. Wealthy families began transferring assets to Switzerland, Canada, and the United States through private banking channels. Scientists and engineers left for better opportunities across the Atlantic, instead of building careers in a high-tax economy with shrinking prospects. By 1960, foreign investment in Britain had fallen 62% from pre-war levels. The pound was devalued over 14% in a single night in 1967 after the government exhausted its reserves trying to defend the currency. Then in 1976, Britain went to the International Monetary Fund requesting an emergency bailout. A former superpower now asking for assistance, like a developing nation in crisis. America takes the throne. The dollar, its rise to global dominance, was officially locked in back in 1944 at the Bretton Woods Conference in New Hampshire. 44 countries gathered there and agreed to rebuild the world's monetary system around American currency. Under this new arrangement, the dollar was tied to gold at $35 per ounce, and every other major currency was linked to the dollar. The timing could not have favored the United States more. America had just helped win the Second World War, yet its factories, cities, and infrastructure were left completely intact. Europe was shattered, Asia was devastated, and the United States suddenly controlled about half of the world's manufacturing output and most of its working industrial capacity. With so much of the rest of the world in ruins, money flooded into American markets simply because there was nowhere else safe to go. Treasury bonds became the most trusted investment on the planet. Dollars became essential for any country that wanted to trade internationally. American banks spread across the globe. American corporations came to dominate entire industries. Prosperity felt stable and permanent to those living through it. That sense of permanence cracked on August 15, 1971, when President Nixon announced that dollars would no longer be exchangeable for gold at any price. In one move, the Bretton Woods system ended, and the dollar became a fiat currency supported only by confidence in the American government and its institutions. Once the gold discipline disappeared, there was no longer a firm ceiling on money creation or government borrowing. Debt began climbing fast. Federal debt stood at $900 billion in 1980. rose to $3 trillion by 1990, and reached $5.6 trillion by 2000. After the 2008 financial crisis, it passed $10 trillion. And pandemic spending pushed it to $27 trillion by 2020. Today it sits at $38.4 trillion. A 4,200% increase in just 45 years. And that is only part of the picture. American corporations owe $13.5 trillion. Households carry $18 trillion in mortgages, credit, and personal loans. Student debt adds another $1.77 trillion, while credit cards exceed $1.1 trillion. Altogether, total American debt now surpasses $100 trillion, a roughly 370% of GDP. Spain defaulted at 200%. The Dutch system collapsed at 250%. Britain lost reserve status at just 130%. The smart money starts moving. Foreign governments have been quietly reducing their American debt holdings for years. China held over $1 trillion in US Treasuries back in 2013, but that figure has dropped to around $760 billion today. Japan remains the largest foreign holder, but even they have cut their position by over $220 billion since 2022. Saudi Arabia has trimmed its treasury holdings significantly. Belgium, Switzerland, and France have all been pulling back from American government bonds steadily. Central banks across the globe have been accumulating gold at a pace not seen in decades. While diversifying away from dollar-denominated assets into other currencies and hard commodities, the Federal Reserve itself has been shrinking its balance sheet after years of buying trillions in bonds to support markets. New Treasury debt keeps getting issued every month, but foreign buyers are not absorbing it like they used to. American government pension funds and federal accounts have become the primary purchasers instead, meaning the government is essentially financing itself in a circular loop. Private institutions have been repositioning just as aggressively. BlackRock reduced Treasury exposure and increased positions in European infrastructure, Asian real estate, and emerging market bonds. JP Morgan shifted allocations away from concentrated dollar holdings. Goldman Sachs cut recommendations on U.S. equities, while Morgan Stanley pushed clients toward international diversification. Bridgewater Associates, positioned for dollar devaluation years ago, has been warning clients about currency risk ever since. What comes next? Reserve currency changes do not arrive with a sudden announcement. They happen slowly, through many small decisions that add up over time. Countries begin settling trade outside the dollar, so often through bilateral agreements designed to avoid the U.S. financial system altogether. China and Brazil now conduct part of their trade in yuan instead of routing transactions through dollar-based banks. India and Russia shifted energy payments to rupees after sanctions made dollar settlements difficult. At the same time, the BRICS countries have been building payment systems that operate independently of U.S. banks and currency controls. Together, this bloc represents more than 40% of global economic output, and reducing reliance on the dollar has become a stated objective. Even the petrodollar system, a pillar of U.S. currency dominance since the 1970s, is showing strain. Saudi Arabia has signaled openness to accepting non-dollar currencies for oil sales, a move that would have been unthinkable a decade ago. Oil transactions in yuan and other currencies mark a significant shift in global energy markets. As global demand for dollars weakens, foreign-held dollars eventually flow back into the U.S. economy. That return fuels inflation that becomes harder to manage. The Federal Reserve would face an impossible choice: raise rates enough to tame inflation and make servicing $38 trillion in debt unbearable, or keep rates low and allow the dollar's purchasing power to erode. In either case, inflated asset prices in stocks, bonds, and real estate would likely fall together as easy money disappears. Why this time is no different. The most common response to all of this is that America is too powerful for any of it to matter. The United States has the strongest military in history, the most advanced technology sector, and the most innovative companies on Earth. What happened to previous empires surely cannot happen here. Spain had the most powerful military in the 1500s, and it did and prevent collapse when debt became unsustainable. The Dutch invented stock markets and central banking, yet their financial sophistication couldn't stop capital from flowing to London when confidence shifted. Britain controlled a quarter of the planet and ruled the seas unchallenged, but still ended up at the International Monetary Fund requesting emergency assistance, decades after losing reserve status. Military and technological dominance have never overridden the mathematics of compounding debt. The other argument is that the Federal Reserve can print whatever money is needed indefinitely. Germany tried that in the 20s, and hyperinflation destroyed the middle class. Zimbabwe printed until trillion-dollar notes became worthless. Venezuela printed until inflation hit 1,000,000%. Printing money doesn't create wealth. It transfers purchasing power from currency holders to asset holders until confidence breaks entirely. Where the money goes from here? Institutions repositioning right now are not making emotional decisions based on headlines or speculation. These are firms with dedicated research teams studying sovereign debt trajectories, currency movements, and the historical patterns that have preceded every major reserve currency transition in modern history. When BlackRock and JP Morgan and Goldman Sachs all start moving in the same direction around the same time, that alignment reflects something more significant than coincidence. These are people managing trillions of dollars who build their entire reputations on getting these kinds of calls right. Capital leaving dollar-denominated assets flows somewhere, and the destinations over the past few years have been remarkably consistent across different institutions making independent decisions. Central banks have been accumulating gold at a pace not seen in generations, treating it as a hedge against currency instability rather than a relic of outdated monetary systems. European infrastructure projects have attracted serious investment from funds looking for stable returns that do depend on American fiscal policy remaining sustainable. Real estate in financially stable Asian jurisdictions has absorbed billions from investors who want hard assets in regions with stronger balance sheets. Currencies like Swiss francs in Singapore. Dollars have quietly gained ground as parking spots for wealth that needs somewhere safe to wait out whatever comes next. The pattern that played out in Spain, the Dutch Republic, and Britain looked inevitable only in hindsight. At the time, each nation believed its dominance would continue indefinitely because their circumstances seemed fundamentally different from whoever came before them. Reserve currency status has never been permanent for any nation that held it. No matter how powerful or innovative or militarily dominant they appeared at their peak,